Welcome back. I'm Tom White, alongside Scott Bauer, CEO of Prosper Trading Academy, and Alex Coffey, Senior Specialist here at TD Ameritrade. Guys, we have markets basically stabilizing here a little bit, Scott. Your take, is this the calm before the next storm? Is that what we'd call it?
You know, if we get something stabilized, that's a good thing, right?
Yeah.
We want to see that. We want to see some stability. But like you said earlier, the last hour of the day is really going to be kind of a telltale. Are we going to hold this? Are we going to sell off as people want to take a little risk off from this rally today going into the weekend? You know, what's going to happen next week? As we spoke about, there's supposed to be some talks with China on the 7th and 8th coming up. I wouldn't be surprised if we moderate a little bit from these levels as the day progresses.
Maybe taking some profits here at the end of the day after this big rally. Now remember, we're only a week outside of the Dow Industrials rising 1,000 points. So being up 620 points right now for the Dow Industrials doesn't seem like a lot, but it is. It is, I mean, significant amount, 2.78% or so. So I think watching these moves into the final hour, final half of the day, I think is going to be key for investors and a lot of our viewers out there. Just stay risk-defying, maybe tight stops and stuff going into this. But kind of wanted to, it is Fang Plus Friday, so I wanted to kind of pivot over to a discussion on Netflix. All right, so we've got the stock up 8% today. Nice little upgrade that we saw from Goldman Sachs today, basically saying this pullback that we've seen, 35% from all-time highs, now down about 30% from those all-time highs. But you got to remember this, guys. Netflix was up nearly 40% last year. Mm-hmm. So, and that's after massive gains in 2016 and 17. Alex, your take on Netflix and what can investors think? After this massive pullback, they still have big subscriber growth. Your take on Netflix?
Netflix is an interesting one. I mean, you mentioned, you know, it's not just last year that they had huge gains, even though they gave a lot of that back, but they've been a stock that's basically doubled, I want to say, almost every year. I remember like when I was first kind of working here at TD Ameritrade, you know, 4 years ago, before this stock split, it was about this price. It did a 7-for-1 split when it was like $700 down to like 100, and it's 3 times higher than that now, and that was in 2016, I want to say, maybe early or late 2015. So I mean, this stock's been incredible. But yeah, the big question is, did it get overdone? Being traded over $400 and it traded down to almost $230, that's a significant sell-off.
Yeah, so this is that subscriber-based model that they have, Scott, and this is recurring revenue. Yep. Every month by all these millions of subscribers, and they're growing internationally exponentially. So when you look at a stock like Netflix with a PE over 100, it always brings back to those days of the dot-com bubble. For me, when you see valuations that stretched, but at the same time, if they're growing, can they sustain it?
It's so difficult to look at a stock like this and look at a PE like that and justify the price. I'm not saying that it's too expensive. I'm not saying it's too cheap. It's a different animal, right? It's not your normal Dow stock that should be trading at X amount of PE. Mm-hmm. What do they have going for them? Well, their continued ability to create new content that their user base just absolutely loves, that's not going away anytime soon. Mm-hmm. And that will probably lead into this expansion in their user base, in the growth in their user base. Is the stock going back to 230 or is it going back to 400? I have no idea. I have no idea whether this PE is too rich or if it's not rich enough. But this is a trend stock. The trend certainly right now is bullish. They just came out with this new show, whatever it's
Bird
called,
Box.
that is like all over. That's the only thing that people are talking about right now.
Yeah.
You know what? And they continue to just come out with this unbelievable content. It's hard not to be a longer-term bull. I don't know what's going to happen next week or in the next month. Hard not to be a longer-term bull.
Yeah, and to that point,
I think those are really good points. And the biggest thing to me about Netflix is it's still priced at such a low point month to month that, like, what's going to make you cancel that? And so that's the biggest thing to me is that they're not.
They have pricing power.
They have pricing power.
So if they raise it $1 or $2 a month, you don't think that they're going to get a big fall off in subscribers?
I don't.
I don't think so. But beyond that, even if it remains the same, I don't see any reason. Even if they're not using it, people who are currently subscribed, like, they're just not canceling it. Like I can say that, I don't know if, like, 11 or
Wait, he's a
$12
millennial. I'm thinking he's sharing a username or something.
I don't know if
probably.
$11 or $12 a month is enough to make me consider not buying it if I'm already a subscriber. Right? If you're looking to cut back expenses, you're probably not looking at Netflix and saying, this is where I'm going to cut back $11 or $12 a month.
Yeah, and especially if they're
If it was
coming
50,
out,
maybe.
yeah, if they're coming out with new content, right?
Right.
And you bring up a good point. The price point that why people are pushing back on cable, right? Because it's getting too high priced, and this is a low entry point. People share usernames, but they do have that growth engine. But we've got earnings coming up, and I think that's going to be big key. Reed Hastings always comes out, touts the company, touts the growth that they've seen, but their spend is just astronomical.
It is.
The debt that they take on to create all this great content, 700 shows domestically alone that they're producing and creating, that takes a lot of capital away. And that's where this bull-bear debate on this name comes into play, Scott. We've got an expected move of about $40 into that earnings event during the January monthly series here. Your take on Netflix, do you do something short-term with maybe 7 days to expiration? Do you try to play earnings at this point based on the moves that we've seen? I mean, it's moved $21 today.
For me, personally, to do an earnings play, it's too far away. I want to wait till a couple days beforehand and get a better handle. I love the momentum in this right now. And going back to just, the whole thought process of a Netflix, this to me is a value product. How many products do you guys own or do your friends own, whether it's an online platform like this or a physical product where you can actually say, you know what, for my $11, $12 a month, I'm getting value for this. This is one of those products. There are not a lot of those types of products out there, and that's what I think they have going for them. Getting back to the trading side, I would not do anything for earnings right now. I would play this shorter term.
Okay, so let's bring that up. As Scott brings up an idea that, hey, maybe we can do something short term, and you've got a $20 expected move just 7 days from expiration. Expires next Friday, Alex, but you've got good probabilities of success. If you're neutral to bullish on this, and what we'll do is just create maybe a short put vertical here. We'll sell the 277.5s, and we'll sell or buy the 272.5. So $5 wide put vertical, you're roughly collecting $1 on a $5 wide short put vertical, neutral to bullish. Your stance on that, because you have good probability of success, it's risk-defined in nature. Your thoughts on this type of strategy if you're neutral to bullish?
If you're neutral to bullish, I definitely don't hate it. You're taking advantage of higher volatility. The only thing I would say on this one is keep the trade size smaller than normal maybe, because I mean, if you're looking at what it's expecting, just another $20, it's moved $22 today. There's a good chance that even if this trade works, that you may have some pain between it working and now. So there's a chance that it's gonna go against you first, and as long as you're comfortable with that, keep the trade size small. I don't disagree with it at all.
Yeah. So we've got the stock trading roughly $300, Scott. If you base it on upgrades, downgrades, and you're playing ahead of earnings, I'm more comfortable with it, not maybe moving down. If the overall equity market moves down, Netflix could definitely, move down $20, $25. We know that, right? That's why we put on these risk-defined plays. That's a pretty good credit.
That's a nice credit.
But let's bring this up on the Analyze tab so our viewers can get a look. And I'll click off on the put vertical. And this is basically what you're looking at here, this unbalanced put butterfly, $2.50 wide each strike. You're collecting $1.60, but you got a little bit more risk. But this is what Scott's talking about. That initial vertical that we looked at had a break-even point of about 276.5, right? But now by doing the unbalanced put butterfly, you've got more risk to the downside, but you've moved that break-even point down to about 269.5. So around there. So it really it goes outside of that one standard deviation move, correct?
It does. And I've also increased my credit that I'm taking in by 50-60% from the 90 some odd cents, 95 cents to about $1.60 or so.
Yep. So the trade-off here, Alex, is that you get better probabilities of success because your long strike, or where this thing starts getting hurt, is below 270, but at the same time your risk is increased on this, correct?
100%. Yeah, the only thing is if you're comfortable with this risk, because with this market environment and this name in particular, that potentially is in play. As long as you're comfortable with that, nothing wrong with it.
All right, so let's kind of, before we actually use that as an example trade, I kind of wanted to give everybody an idea what those probabilities are. So if you sold the original put vertical, you had a 73% chance probability that that would be out of the money at expiration in 7 days. But if you go down to that 270 and lower, you got about an 82% chance that it's going to be out of money. So that's the trade-off. Bigger risk, but you got better probabilities in your favor. Both risk defined, that's the key, I think, right, guys?
It's all about reward to risk. It's all about knowing your risk. It's all about defining your risk. And if you're comfortable with it, like Alex said, you know what? Have at it.
All right, great discussion on Netflix and different strategies for basically the same directional bias on that, but good discussion there, guys. I'd like to thank Scott Bauer, CEO of Prosper Trading Academy, for joining us.